Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. Thank you so much for joining during the Meg 7 earnings season. It's happening. It's right now. It's here and now. We started off with Netflix. Had the one golden goose of the marketplace right now is Netflix, as far as the tech space is concerned. Netflix had strong earnings, no real worries about the tariff situation, growing the user base. Stock has been representative of that. They announced earnings on the Thursday before the Good Friday market holiday, which made things a little bit interesting and made us I actually did an education piece because of that scenario that happened in Netflix that we posted on the Good Friday market holiday. And now we decided to come back and actually do a skip strike butterfly based off of the fact that Netflix announced on a Thursday. The first day of trading after that announcement was Monday. And the stock has been extremely strong since then, and volatility kind of hung around, but volatility is hanging around everywhere, right? We still have the VIX, not really retracing a ton relative to the huge market move, but the VIX is still trading pretty close to 28 at this point in time. So high volatility just in general. We do got a VIX trade on that's looking really good, obviously, because the market's back up, but going out to the mid-May expiration, and that trade is doing very well today. And then on the Netflix trade, extremely interesting price movement that we got on the Netflix trade. So if we look at our Netflix trade, which is just kind of fun to talk about because right now, I don't know if you could have it at a more perfect area. I don't even know. Perfect is a strong word when you're talking about Netflix. We went out to the Friday expiration, which is the 25th, but we need time decay to happen, right? So here's what has happened with Netflix. We put on the trade, and I'm going to zoom in on this. Let's run to the Tradier Pro software, and let's look at this area of the chart. All right, so they announced earnings. Here's the big move. Came all the way up to our short strike. Hung there for just a little bit. Closed at the 140 level. Now we're back up 1,055. We do need some time decay to happen on the trade. We are looking for it to land right at 160. 425 is the expiration date. The center of our strike is 160. And what we were targeting is that the stock would run up to this level and then struggle to break through it. And that's what all these candles are saying. We're still at this level. And if we do break through to that level, it's another good sign of Netflix. It's hard to imagine Netflix continuing on and setting new, recent highs in the marketplace with the market struggling so hard across the board. But we are seeing a lot of the Meg 7 stocks bouncing back a little bit today. We're seeing even Apple, Nvidia, Tesla had a bounce back too on top of it, even though they had an absolutely horrible quarter. But Elon Musk was able to save the day once again with the conference call after their earnings report. But across the board, the numbers were pretty bad actually in Tesla, and they still have some tariff exposure too. But we see even Google up today, and good day in the market, I guess. Let's just leave it at that. It's good to see the tech stocks just kind of bouncing back a little bit. Netflix is leading that challenge, but we have a couple of days left. The only thing about it is that it's moving too quickly towards our strike price. So if we go back and we review our Netflix trade, here's the strikes that we are using. Here is the April 25th expiration. So we are looking at the 1,050 strike on the call side. We bought that one, selling two of the 1,060s on the bid, And oops, let's clear this out because I didn't hit buy on the first one. 1050s, we hit buy. 1060, we hit sell. And then we're going to skip that. And we're going to go to the 1080 and we're going to buy that. Right now, we're looking at a net credit of $1.57 on this. Well, God, what just happened? Up 16. Did we just jump on that? It was 177 just before. Yeah, 156. Yeah, we've moved up about, moved up about 4 points on this trade since the beginning of the day. We'll call it $2. So at this point in time, we really need the 160 level to hold. If the stock goes up towards the 170 level, we want to get out of this trade. We really want this level to hold today and look to exit it. If we land at 1060 on Friday, that would be our best case scenario. If the market, it's really jumping. Holy cow. I don't know what just happened, but the stock just jumped 10 points in like a second. All right. So with that said, now we're in the danger zone. We're at 1061. This is 245, 250. Yeah, it's moving against the position hard. We need that 160 level to hold today. And if it doesn't hold, we got to think about getting out of this trade. The 140, when we came to bounce back after the earnings report. All right, we'll come back and review this. We'll look at Netflix. I don't have any idea how. Maybe they knew that we were talking about Netflix on Options Guy TV. And so the marketplace took hold and decided to move the stock 10 points in the last 5 minutes, because that's what just happened on Netflix. All right. SPX, we looked at an SPX trade. This trade, if you made an adjustment on the trade, the adjustment that we usually do, that worked out just fine, but you had to make the adjustment. So if we're looking at the SPX open wing butterfly, and remember, I always think of an open wing in that we don't limit ourselves on the downside to the net debit that we paid for it, where we have, if we don't land within the strikes, that we don't benefit from the trade. So let me send this one to the what if calculator. Let's see where this thing goes. Might have to get out. I don't know what's going on in the market, but we might have to get out of the Netflix trade. If you didn't close it yesterday when it was down around 140, the market is moving strong right now. All right, now let's go and grab the SPX trade. So in the SPX, the strikes that we had on, I mean, we've ran away from them. So I don't even know if it's worth bringing up right now, because we have the S&P 500 index right now at 5438. And the strikes that we looked at were the 5150, the 5130, and the 5115. Open wing butterfly means if the market went below 5115, that the trade would be profitable. Did it for $2.75, $275 per 1x2x1 butterfly. You would have had to make the adjustment yesterday when the market moved up, and there was many possibilities to do that, where you'd roll that into a short put spread. If you did not do that trade, well, now we've ran too far against that position, and it would be hard in order to, well, there's not much you can do about it. It was limited risk when we put it on, $2.75. Now, the adjustment would have been to sell the most expensive strike, which would have been the 5150, and then either buy to close one of the 5130s or buy to open the 5115s. So I guess I could go back and show that, but there's just not enough life in it to make it that interesting. Here's the expiration date, was the 23rd. So here is today, 5150. buy 51. Now we got 51.30, but I'm froze. There we go. Sell 2 and 51.15 buy 1. $51.50, $51.30, $51.15. So this is 20 points wide, and this is 15 points wide. We'll send it to the what if calculator, and I will show you real quick what I mean by the open wing in that we zoom in on this. If the market goes all the way down this way, we are open on that trade. In other words, we can make $5 or sell the butterfly for $5. But what has happened is the market has ran this way all the way up to 54.30. So the adjustment, which could have been done on Tuesday and you would have been okay with it, is to go in and sell this put option and then buy to close one of these. And then you end up in a short put spread. Now, if you do that, you try to bring in a net credit that's going to cover the debit that you paid, which was about $2.75. So my goal would have been to try to do it when that spread could have been closed for around $4, giving yourself a little bit of upside. If you wait a little bit long, the other adjustment is to sell the 51.50 and then buy the 51.15. Now, if you do that, you're short 2 put spreads. So if you got more than one butterfly on, you're adding quite a bit of additional risk to your trade. But at this point in time, if we send this trade to the well, right now, yeah, it's trading for nothing. There's no reason to close this trade or try to adjust the trade. The adjustment would have came yesterday, basically on the open yesterday, when we saw a fairly strong market open and then medium trading across the board. All right, let's get into the, well, let me ask if we have any questions. As always here on Options Guide TV, we try to make this as interactive as possible. If you have any questions on these trades, the Netflix trade all of a sudden got scary. And I obviously don't know why, because it just happened since we kicked off the show. But now we're going to look at Google. So in Google, I'm going to ride the bullish momentum. Now, Google's really gotten beat up, and the story about Google is not fundamental. It's not even necessarily about tariffs. It's about the fact that the government is investigating them. It's about the fact that AI is coming. Is Gemini as good as ChatGPT, which is as good as Gronk AI? Who's going to succeed in the AI space, and will Google able to maintain their hold on search with everything that's going on? So on a fundamental, on a PE, on a forward PE, on a potential earnings announcement, on success of YouTube, on everything that Google has going for them, if you just look at that information, Google looks really strong. It's behind the scenes, which is a little bit scary. But I do feel like we're now down at in a range where I think heading into earnings, and Google is, well, they're not, the CEO isn't quite like Tesla, where they're going to come on out and really push the stock. They give you the numbers and they let you determine what you really want to do. But I do think that they'll have a solid quarter. So I want to do a very simple trade in Google, and I just want to get bearish heading into their earnings report. Now, the stock is up 3% today, but the entire market up. So everything is pulling us forward. And, we've had quite a few earnings across the board that have been announced. And I guess the theme so far in earnings has been, we're looking good, but the consumer's doing okay, but we're seeing slowdowns. We're worried about policy going forward. We want some get rid of some of the uncertainty in the marketplace. So we're kind of slowing down what we're doing, trying to figure things out going forward. Google, I think, has things figured out. The biggest hit to Google would be the antitrust situation that is going on with the lawsuit against them, and geopolitical concerns. But the stock's been beaten up for it. So we're trading at 156 right now, and here's what my trade is going to be heading into the earnings report, which is Thursday after the close. Now, you might want to wait, and if you want to just make it an earnings play, you would put this play on tomorrow closer to the close. But I kind of want to ride a little bit of the momentum here, and I'm going to lean to the upside. We're going to do the very short-term expiration, so this is going to be an all or nothing trade. We're going to go a little bit in the money. The stock is at 155, and we're going to speculate on this. We're going to give ourselves some solid upside. We're going to buy the 155 strike call, and at the same time, we're going to sell the 165 strike call. Getting a lot of vol premium here, right? 100% implied volatility. We're buying, but we're selling something that's got a 90% implied volatility. And that's mainly because it's a little bit out of the money. There's a little bit of skew here. And so if we do this trade, we're going to get this done. Let's call it $4, $3.98. I think $4 is very feasible. We do need the stock to go at least to 159 and beyond. So right now, the expected move on the trade is about $9 and let's call it 40 cents. That's by looking at the long straddle. If we bought the at the money call, we bought the at the money put. So we're basically setting this up to say we're going to buy a just in the money option and we're going to sell an option that is right outside of the expected move. So if we do get a positive upside potential, the maximum that we can make on this trade would be $6 with the market at 155 if we could get out at 165. And we're going to find out really soon because we're just going to give 1 day for this underlying stock to run. If you don't think we can get up to 159, well, we got all day today, all day tomorrow, the announce earnings, and then all day on Friday. So that's the concept. You can set up the trade fairly close to these type of parameters if you wanted to tomorrow, closer to the close. But I'd like to jump in on the momentum right now. So very straightforward trade. Stocks at 155.62. We're buying a long call spread on the April 25th expiration, 100% a earnings play trade. So manage your risk accordingly. If on a less speculative play, you would do 2 contracts. Consider this a real speculative play. So you're going to do 1 contract. You're going to cut the amount of contracts in half. And that's the way that I would play this by looking at the Google trade. And very straightforward, very simple. And I think that's going to be it for today's Options Guide TV. Are you, if you have any questions, please do put them in the chat box right now. And if not, well, be happy, right? We have a little bit of upside momentum. Leanings market's feeling a little bit better. The VIX is down below 30. Earnings aren't bad. There's trepidation still in the marketplace, but like to see the VIX coming off a little bit. Earnings have been a good thing so far. And that's kind of, I think, the theme. And hopefully that theme holds up for the next couple of weeks and we can get some upside momentum to try to carry us through the rest of this earnings season. Thanks for stopping in. My name is Brian Overby. We'll be back on Friday at 11 a.m. Eastern time for the next edition of Options Guide TV. And we'll see how the Google trade works out. And in Netflix, we backed off a little bit. So thank goodness on Netflix, we're at 1,054.05. So We're not quite in the danger zone yet. So the 160 level is holding. All right, let's hope it holds. All right, talk to you soon. See you this Friday, 11 a.m. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.